Hello, everyone. Courtnie Nein here, and I want to welcome you back to another episode of Making Sense of Investing with Court. I am joined again by Noah Brooks, the Director of Investments here at Good Life, and this is our third quarter episode. I don't know about you, but summer is completely flying by. The boys are going back to school next week already. I have Graham going into seventh grade, and he will be starting junior high soccer
Wow.
and juggling Reading Rage schedule. I have Colt going into third grade. He just made a junior Reading Royals hockey team, so he's going to be playing ice hockey as a goalie. And
Nice.
my soon-to-be stepson, James, is going into second grade, and he is going to start wrestling. So we have a jam-packed fall ahead of us. I'm definitely excited for the fall, but a little sad summer's over.
Next week, though, that is really early.
It's very early, and they're really not getting out of school any sooner than before, but I guess we have like a 16-day break over Christmas vacation.
I can remember, this is a long time ago, but I can remember elementary school. It was like second week of September.
I know, going back after Labor Day at the latest.
Wow.
So this is the earliest the boys are going back. So I do think we got shortchanged a little bit, but we had an awesome summer. It was nice being able to spend a lot of time with them. So how about you, Noah? How was your summer?
It's been a great summer.
Yeah.
I haven't really done that much.
No,
but
get out on the boat at all?
A little bit,
lake?
not too much,
okay.
But a few times.
Yeah.
No water skiing this year.
No, I know. I didn't get out. I water skied with Noah a few times on Blue Marsh Lake, and we had a fun time. So, do you have any plans for the fall at all?
A little bit of international travel. Yeah,
okay.
We're hitting Prague, Copenhagen,
Very
Amsterdam, cool. And Sweden.
All right.
Yeah.
That sounds fun. That sounds fun. So we are going to get right into it. August it's been an interesting one. It's been a lot of headline news, a little bit of volatility to say the least. I'm going to turn it over to Noah and just kind of highlight, I'm sure many of you have been watching the news, especially the first week of August. And we had some record days for the month in a good way and a bad way. So Noah, can you just kind of catch us up as to the start of the
everybody
month?
wants to talk about last Monday and last week, but before I get there, I just talk some basic figures. S&P 500 as of today, before we walked in here, was up 16% for the year.
It's pretty amazing.
So yeah, this is a great year. If we ended the year today, you'd go, wow, that was a really good year.
It's a good year,
right?
Yep.
Bond market, not so much. The U.S. Ag is up about 2.75% for the year.
Better than negative, because we were on a 5-year, decline. I think it was a 5-year negative return.
3.5 year completely negative return in bonds, and people were starting to question why they own bonds. So coming back a little bit, so that's the bond. Ag is up 2.7. High yield bonds are up a little bit more than that. Some corporate bonds are up more. Depending on what municipals you may or may not own, they're up a little bit more. But I mean, so in addition to S&P being up 16 as of now, small caps are up about 4%, mid caps are up about 8%, and internationals up 8 as well. Both emerging markets and developed markets are up 8. So all positive, but right, and this is the but. I mean, the market freaked out last Monday. Yeah, I mean, that's the bottom line, and we can talk a little bit about some of the root causes of that. Were clients calling?
I actually, I was excited. I had a couple people call, but I had more people calling to see if it was a good time to put money in the market.
Yes.
So I was like, this is good. This is a good sign. And I think, not to get ahead of ourselves, but I think with the way things are right now, I think it's safe to say that other people had that mindset, kind of buying the dip. So it was good to start to see that again, because I feel like it's been a while since we've seen that. I think volatility has scared people in the past, and you by nature want to just kind of go in the corner and hide or sell, and it's like the worst thing to do. So it was nice to see that people were actually buying in, and that was even with the talks of, are we heading into a recession? And is the Fed going to have to do an emergency 50 basis point rate cut in between Fed meetings? Like all things that we don't want to have happen. So the fact that people were, I would say, more inquiring as to whether it's a good time to invest versus getting scared, for me, that was a positive sign.
Yeah, it felt like the financial news outlets, whether it was Bloomberg or CNBC, on Monday night, they had the markets in turmoil logo up, and they had the special and all that. Here's the bottom line. So a lot of this was precipitated by the Japanese markets. So the Nikkei, which we don't invest directly in, but we do indirectly, had been at an all-time high back on July 16th and started to come down. And then it had some really big days. But so at the bottom on Monday, from the top on July 16th to the bottom on Monday, their market was down 25%. Yeah. And that's a lot. And Monday it was down 12%. Friday, the Friday prior to that Monday, it was down over 6%.
Yeah.
So it really came down, and this is what all the financial news service was talking about, what they call the Japanese carry trade. And let me just explain it, because you probably have heard it. Anybody that's looking at the financial news has heard it. Essentially, a carry trade is when you borrow money in a low interest rate environment from a currency standpoint, and you invest it in some other currency, right? So you're borrowing and Japanese rates are very, very low, like low. Ours were a few years ago. So they're borrowing, let's say, in Japanese dollars, and they're investing, it could be in US dollars or some other, EU dollars or some other currency that has a higher yield. And they call it a carry trade. And so you have this situation where all of a sudden that comes to an end, and then their markets blow up, and that carries over, not the carry trade, but it carries over to the US markets, and everybody gets freaked out, and there was some selling. And I think at the end of the week, the S&P essentially was down about 0.25%.
Yeah.
I don't want to call it a nothing burger, but realistically, it didn't change all that much in terms of the forecast for the markets. We still think that there might be a soft landing, which means that there could be a recession. We know that the jobs, the jobs data that's been coming in is slower.
Yeah.
And unemployment rate is climbing a little bit. We can talk about that, because it's weird that you're still creating jobs and the unemployment rate is climbing up.
Yeah.
So we can talk about that a little bit. But so Chris, one of the research analysts today, he called it an earthquake on Monday. And what follows earthquakes? Tremors. Yeah. Right? Little tremors. So it wouldn't be surprising to see some tremors that come into the market, but that was the shock.
Yeah. I think it was the first time, and again, if I'm not right on this, correct me, but I think it was like the first time in a couple years where bad economic data or news actually been a bad day in the stock market. We haven't seen that. It's kind of been the opposite. And I know I've talked about this in client meetings, where when there's bad economic news, it's almost been like the market's been creeping up, because it's like the hopes that the Fed's finally done raising rates and we might get some reprieve there. And then when we have good economic data, it's like, oh, we're going to be in this higher for longer rate environment that nobody wants to be in. So I think it was, the first time that we actually had a not great jobs number. And of course, we went right to the R word with a recession, and probably scared a lot of people.
Yeah.
But it was really the first time in a very long time where, we really had some not so good news, and it really meant some not so good news in the market. And then on the heels of that, we obviously had the Nikkei, as Noah had said, we were down, or they were down, like worst day since 1987.
Yeah.
So
serious.
Doing the math, I'm 38, so that's 37 years. So not a good start to that Monday. And then I think they had the very next day or the day after, they had their best day since 2008. So those are like huge extremes that we have seen, and I think it goes back to the importance of staying invested, and we can't react to that one bad day or one bad news. The clients that did call me, I sort of said, we need to just get a little bit more data. And what I mean by that is if we have a couple more days of this like massive selling, then maybe we are onto something, or we are the start of something bigger. But if it's just like a bad day, we can't just upend all of our plans because we had a bad day.
Yeah. And to put this in context, I mean, one of the things that's happened is we've just rallied all of 2023 and the majority of 2024, especially large cap technology.
Yeah.
Your NVIDIAs of the world, your Microsofts of the world. And to see them come back a little bit, I mean, that's part of a healthy market.
It is.
So it's not that we don't think one way or the other in terms of them continuing to fall. Right now, they're not. They're rebounding.
Yeah.
NVIDIA was down to almost 91 from 140, and now it's back up to 120.
Right.
So there's there's something to be said for a healthy market and a little bit of rotation.
Yeah.
So, one of the things that we watch is the difference between large companies, mid-sized companies, and small companies. And large caps have really outperformed.
Yeah.
And we think that there's significant possibility that small caps will start to outperform. It hasn't happened, but everybody is waiting for, what is it? The Federal Reserve to lower rates.
Lower rates.
So whether Microsoft can borrow at 5% or 2%, doesn't matter. I'm not saying it won't affect their earnings to some degree, but a small company, $1 billion company or a $500 million company, the difference between a 2% loan and a 5% loan or a 7% loan
it makes a big swing,
major impact on earnings. And so that's why when we actually saw on Monday, small caps underperformed large caps, not large cap tech, but large caps in general. They've come back, not quite as much as large caps have.
Yeah. And I think really since 2022, small caps, they went down as much as the large technology companies, which have come roaring back. And I think it's been a really slow grind for the small caps to come back.
Yeah.
So yeah, I think that's kind of a little bit of the environment that we're in right now. And I think it was probably the first time that the AI stocks sort of got a reality check with their major growth numbers. I think they're trading at like 50 times PE or something.
They're expensive, right? From a PE valuation standpoint, they are
normal
expensive.
PE stocks are, just for our viewers, what are the normal PE?
S&P right now overall is around 19.5 times next year's.
Yeah. Historically,
15 to 18.
So 15 to 18 times earnings, and you have technology companies trading at 50 times. That's a big
therein lies the rub, is that they've had this amazing market move, and rightfully so, because the technology that they're going to be bringing online over the next decade is going to be game changing.
Yeah.
At the same time, they are priced for perfection. Trading at I think Nvidia was 42 times revenue. So it's one of those things where if there's a stumble, you're going to have a pullback,
right?
And it can be quick and fast, where you may not get that in, like a Berkshire Hathaway or a Citigroup, some of the value stocks out there, because they haven't had such a big run. Not as many people, I don't want to say are interested in them, but they're not the talk of the town.
Yeah, and I think what was the Magnificent Seven a couple of years ago, they made up such a huge part of the overall S&P 500. So you get any one of these stocks have a bad day or bad earnings, even if you don't individually own that stock and you just own a general index, you're going to feel that pullback happen. So
there's no question about it.
So yeah, that was a catch up on really what happened over the course of the last week and sort of the big headline news there. But generally speaking, Noah, where are we at? I like to do this podcast with you sort of halfway through the quarter, because by then I feel like we have a little bit of a better sense of where earnings are coming in at, and companies have maybe revised their outlook for the current quarter that we're in. So for me, the timing wise, I think to get the most up-to-date information to all of our clients and viewers, this is kind of it. So now that we're sort of nearing the end, I guess you could say, of earnings reportings, like where are earnings at right now?
As of Friday, 92% of the S&P 500 has reported. And if we closed, if today was the end, the earnings growth would be the highest since 2021. It's 11.5.
Okay.
11.5 year over year earnings growth, which is really good.
Contributing to, great returns that we've had so far for this year.
Yeah. Now everybody goes, okay, so it's the highest it's been since 2021. And for the record, that number was 31% because that was the COVID rebound.
Right.
Right. So that's a little skews the numbers a little bit, but 11.5 is definitely the highest that it's been. So the question goes, okay, well, is this the top? Right. I mean, if rates are going to come down, that's going to be positive for earnings. And there's this question of implementation of AI, right? How much savings will it do? How much efficiency will it bring? If you think about it, I think we just had the anniversary of IBM launching its first desktop or PC computer, right? It was like 1981. And we went from big mainframes and everybody typing to, everybody, I don't know anybody that doesn't have a computer. Obviously,
I don't think you can function
silly.
Really.
No, you can't function.
You might not love using it, but it's sort of a necessity.
It is. And so the efficiency that artificial intelligence is going to bring is just going to allow workers, you and I, to do more increasingly with less. And that's where the earnings growth really will come in from some of the big companies.
Yeah.
I'm sure you've been into a fast food place where you're doing your own ordering.
Yes.
Right.
Even the mobile apps. I mean, I know my boys, when they get done with their crazy sports schedules, it's if we're on the run, they're pulling up the app on the phone and just placing the order, and we're scheduling a pickup for a time when we know we'll get there right after practice. So I think things have improved drastically in a good sense of the way.
There's no question about it. So we think that earnings growth can continue to be positive, but the reality is that there could be a slowdown. We were in a position where, I don't know if you did it, I can tell you that I was doing it, revenge spending, right? I mean, 2020, we didn't do anything. 2021, we didn't do anything. It wasn't really until the end of 2022 that we kind of like came out of our shells. I'm not saying we didn't do anything, but we weren't doing a lot of traveling, or if any traveling. And I think a lot of people were like, okay, I have to make up for those 2 years by doing all this stuff. And so what we see happening now is more just a return to normalization of spending.
Right.
And the difference is that there's going to be, if you return to a lower rate from a higher rate, technically that's a slowdown. But it's not a slowdown that's going to result in a hard landing. We think there's a soft landing coming, and it's really just a normalization of spending.
And that really was the goal of the Fed with its interest rate, campaign hike. I think it was 500 basis points hike camp that we were on. So the goal was to slow the economy down. So what's happening is what was intended to happen. And I think that's where we all need to get ourselves back to reality a little bit. And, the point of this hike was to do exactly this. So here we are. I have seen some things where, we're like looking at, I guess it was when the start of COVID to when the market sort of bottomed out, I guess on the Dow Jones call it was like 18,000. I was going back, and I think by November of 2020, so from March of 2020 or April, whenever it had bottomed out, well, probably May, I guess, of 2020 till things sort of bottomed out, we fully rebounded back to where we were at the start of COVID by like November from Dow Jones
I think
level.
I think it was 91 trading days.
Yeah, 91 trading days or something like that. So, that was a major event. And within 91 days, at least it took a little bit longer for returns to come back. But from a market level standpoint, we came back. We did have that V. So now it's like, okay, where are we at after that major event happened to where we are now? I think we have to kind of look at some of that data, because up until maybe last start of maybe 2022, or before things kind of turned down, I think the market returned almost like 100%. Well, it really wasn't 100% return because of earnings. It was, we went down so much, and there was so much overselling from a panic standpoint that, now we're getting back to normal markets, which we truly have not seen in.
Well, you say normal markets.
Normal markets, I just want to say, like, these
there's
huge.
No such thing.
I know, but
market.
Like 16% return by August is an exceptional year, right? When we look at total returns.
So if we talk about long-term returns, we can say that the stock market, depending on which market you're looking at, you're going to get between 7, 8, 9% annualized return
per year.
But you're never going to get 7, 7, 7,
right.
7, 7. It's not going to happen.
It doesn't happen.
You're going to have these big spikes. You're going to have the down years, and you're going to average out at a reasonable return.
When I say good normal markets, it's bad news means a bad day for the market. Yeah. Those are the normal things we haven't had, and we've had bonds and equities almost all going down to get things were correlating that don't normally correlate, right? So I think hopefully when we're anticipating the Fed cutting rates probably in September, we might start to get some normalization of asset classes acting like normal asset classes act.
Well, so there, you said about the emergency rate hike. It's like, why the Fed is doing something is as important as what they're doing.
Right.
If they're lowering because the data suggests that inflation is low, is coming down, and we'll talk about that because the CPI just came out this week, PPI came out yesterday. If they're lowering because data says they should lower, then everything's great and we rally. If they're lowering because, oh my gosh, there's a pending doom coming around next Wednesday, then you're like, oh, we got to sell.
It's a different story.
It's a different story. So you can have different reactions for the same event, same action.
Yeah.
Yeah. Different reactions to the same action. Say that 4 times fast.
I'm not even gonna attempt. So Noah, now that we are talking about CPI, can you break down exactly, in a basic terms what that is? And that's different than, and we talk about inflation versus prices. Obviously, food prices, I think since 2021 are somewhere up like 25 or 30%, but we're talking about CPI.
Yeah.
So can you
let me start by saying what the CPI number is and what came in yesterday. So the year over CPI's consumer price index was up 2.9%, which is really good. It's the first time that it started with a 2 since 2021, right? So it's been 3 at the height in 2022. I think November of 22, it was over 9%. So now we're down to 2.9. And just because inflation is coming down doesn't mean prices are coming down, right? So those are two different things.
Yes.
Inflation is the rate of change in prices. And so even a 2.9 means that overall, and CPI is a basket of goods and services that includes every, food, energy, cars, everything, fuel, housing is a big component of CPI. Rents are a big component of CPI. But a 2.9 doesn't mean, even though it's good, it doesn't mean prices are coming down. Now, last month, this is the first time that since COVID, the prices did come down. It came down, the CPI, the month over month number was negative 1/10. Okay. Not that you're going to feel that. This month, it was positive 0.2, right? So prices are not coming down. There are certain categories of prices that have come down dramatically. I don't know if you were you building anything a few years ago?
Yes.
Yeah, you built a house. Yeah, lumber, right?
Yeah, lumber.
So,
great timing.
I don't know specifically for a 2x4, but lumber contracts were upwards of $2,000 per contract. Today, they're at 500. I mean, that's a gigantic move down. Used car prices have come down dramatically. I think they're down about 25% from top to bottom. When you go by the Audi dealership on 183, they're stocked.
Yeah, it's a full inventory.
Right? So they cannot raise prices anymore. And that supply chain issues, they're done. I mean, we're not COVID with TP and stuff, but like just getting stuff from China or from suppliers, those issues are gone. So a lot of the price increases that we saw and inflationary stuff was supply chain issue. There's other reasons as well, but those issues are gone and we are seeing prices come back down. It doesn't mean, and this is the big takeaway that I want everybody to think about, it doesn't mean that prices on everything, especially groceries, because that's the thing that I hear the most, are going to come down. It means they're going to slow down the increases. Yeah. If we have prices come down, it means we're in a recession. Yeah. Right. And they're like house prices. Now there's certain areas, right? Housing is about location.
It is.
There's certain areas where you're going to see some real estate prices come down, but on the aggregate, in the last 50 years, they've really only come down a few times. They came down in 73, 74. They came down during the global financial crisis. Yeah. 07, 08. That's it. Yeah. I mean, housing prices are not, certain areas, sure, but overall, I don't know.
Yeah, no, I definitely feel the same way on that. So Noah, we touched on CPI. We know September is probably the date for our first Fed cut.
Yeah,
it's pretty much priced into the market now, right? So I've been sort of telling clients the market's always forward looking, so we know that that's almost a given at this point.
Yeah.
So if it doesn't happen, there's more downside. But if it does happen,
well, so there's the interesting thing, right? So if it doesn't happen, does that mean the economy's in great shape? And if it does happen, does that mean the economy's in poor shape? No. It's like, are we being hypersensitive to the data, or are we just being like, okay? So I think it's one of these things where we are going to get a decrease. The question now is it going to be 0.25% or is it going to be 0.5%?
2 weeks ago, we would have said 0.5%. We were talking about an emergency one. Not going to happen. Don't think so anyway, unless in the next few weeks we get some really bad data. But I think my opinion is it's a 0.25 point drop because it's not going to move the needle too much, but it's a good test to see how the markets do react. And maybe see what happens after that.
It's also going to be the first one after you said, 5% increase. And so it's not so much 0.25% isn't going to make a meaningful impact on corporate earnings. It's not going to make a meaningful impact on a lot of things. The yields on mortgages have actually already come back down. Yeah. So they hit somewhere around 7.5 last year. we're at about 6.25 today.
Yeah, I think the interest rate, like they're already pricing in the fact that there's going to be a cut.
Efficient markets.
Efficient markets.
Right?
Yeah.
So you have the situation where whether it's 50 basis points or 25, I'm not sure that it's going to make a big deal. But the messaging, meaning that, okay, this is the end of high rates and we're going to start to see lower rates. And it's kind of like all clear.
Yeah.
Right?
Yeah.
I mean, that's what it is. And inflation is a big deal. Now, moderate inflation, and keep in mind that the Federal Reserve, their mandate is two things, meaning they're tasked with two items. They want to see full employment or as much employment as possible, and they want to see price stability, which is code for reasonable inflation, not 9%, not 6%. Their target is 2.
Yeah.
Now, if you go back to, I'll say, the best market that I've ever seen in the 90s, right? So from like 94 till 99, inflation was in 1 to 2.5%. And they're saying 2. So we saw 2.9 yesterday. Are we going to get to under 2? I don't know. Are we starting with the 2 today? Yeah. So certainly that could happen, but it's really about the start of that easing cycle.
Yeah, showing that we're turning the corner.
Yeah. On
what's kind of been a historic thing.
Sure.
I haven't seen this for a while. So the last thing that we're going to touch on is just, we get it all the time. It's obviously election season's coming up.
Is there an election coming
up? There's an election coming up.
Oh, wow.
Volatility, or, the VIX, as it's known in the now world, was high. It was the volatility index was high the last few weeks, really to start the month of August, mainly because of all the reasons we've already touched on. But what do you think we can and should expect from a volatility standpoint leading into the election? And statistically speaking, some people just say, take me out of the market till the election's over. So what's
do you want me to tell you who's going to win?
No, we're not going to go that way. This is a non-political answer. This is just the importance of staying invested even during election cycles, and statistically speaking, what that looks like.
Yeah. I get the same thing sometimes.
Yeah.
I think so-and-so is going to win and the end of the world's coming.
Yeah.
And you got to do this. Well, so LPL had some great research on it. And before I touch on that, I just want to say I was under the impression that the Federal Reserve, when I say under the impression, my 2 cents were that the Fed wasn't going to move before the election because they want to be seen as apolitical.
Correct.
Right.
Which we talked about.
Yeah. That's exactly right. They don't want to move and say, oh, well, it was going to help this person, or it was going to hurt this person, or vice versa. So there is still a chance that the Federal Reserve doesn't lower in September. It's not a big chance, but it's possible. Okay, so moving on. I had some great research from LPL, our custodian, and they went back to 1950, and they essentially said, if you put in $100,000 in the S&P 500 in 1950, and for everybody out there saying, well, the S&P 500 wasn't around in 1950, it was the S&P 90, and in 1957 the S&P came out. So just in case anybody questions it, if you put in $100,000 in 1950 and you only invested during times where they had a Republican administration, today at the end of the mid-cycle here, mid-year, you'd have about $1 million. I didn't do the math on it, but not a great return for 74 years. If you had only invested that money during times where there was a Democratic administration, it was about $3 million. So a little bit better, but not that great. If you had just left it invested and done nothing, it was $32 million. And the difference is when you stop your compounding, because compounding is how you build generational wealth. Right? It's the return on top of the return on top of the return. When you stop your compounding, that's it. And so I don't know who's going to win the election. Obviously, I was joking on that one. It seems like it's a toss-up right at the moment. Each candidate has their own pros and cons. Yep. But when people say, take me out because of this, that's an emotion. Mm-hmm. It's not a data point that you can use. You can make a case that, what I just said, it's higher under Democratic administrations. You can make a case that more recently, it's higher under Republican administrations. It's how you craft that data, right? Lies, damn lies, and statistics. So we don't want to play that game. We don't want to stop our compounding. And so whoever is in office, we are not recommending changing your investment strategy. You know, there are certainly items around the peripheral that might have traction, you know, based on regulations or lack thereof. But overall, you know, whether Microsoft earns $5 a year or $5.10 a year isn't going to matter on who's in the administration.
Yeah. Those are big numbers. And I think it goes back to the whole theme of everything that we really touched on this episode was the importance of staying invested and not being emotional and not reacting to big swings in the market, not reacting to, you know, pending news or pending elections or anything like that. And so I think, you know, hopefully for our viewers out there, that really is the main takeaway that you got out of this. On top of the fact that we do think interest rates are going to be probably, you know, cut hopefully by a quarter basis point in September.
Maybe 50.
Maybe 50, although we feel most of that is already priced into the stock market. So there's that. But overall, you know, bad days happen. We have bad days, right? But it doesn't make for a bad week, just a bad day or a bad moment. And I think it's important that we just stay on track with the overall financial plan, whether that's continuing to invest because that's what we said, you know, you needed to do X amount per month for the next so many years to reach your financial goals. We just have to make sure that us as advisors are coaching each of you to stay on track and just continue the course because the ups and downs happen. You know, the Japanese markets went worst day from 1987, followed by the very next day, the best day since 2008. It's a telling story. It's a powerful one. So, Noah, thank you so much for joining me. And for all of you, thank you for tuning in today. And whoever is going back to school next week, whether you're a teacher or you have children, we wish you the best to the start of the school year. And we look forward to seeing many of you throughout the remainder of the quarter. So
stop in and say hi.
And enjoy the last few weeks of summer. Take care.